someone is asking about shared services. So yes, that's a great question. You would not necessarily move all of your operations to the US. You may leave some operations behind in Singapore or in Asia, and therefore there'll be shared services, right? So the company that's in Asia may perform functions like accounting, marketing, some admin, back office stuff for the company in the US. So there's some sort of shared services going on. That is something that you need to pay attention to. It may be subject to something called transfer pricing. What is transfer pricing? So transfer pricing is a discipline that kind of like is in between economics and taxation, that looks at determining what the appropriate price is for intercompany transactions. So because you know where we're going with this, right? So obviously Singapore is all things being equal, it's a lower tax jurisdiction in the US. So there may be an incentive when you have two companies, one in a higher tax jurisdiction and one in a lower tax jurisdiction. There's an incentive somehow to try to shift the profit from the high tax to the low tax jurisdiction. Obviously, tax authorities are aware of that. And in order to manage that, and to ensure that the price is genuinely arm's length and it's not any attempt to shift profits artificially, there's the whole discipline and the rules around transfer pricing. So transfer pricing ensures that you get an arm's length price. So it's as if a third party pretended a third party provided that service. However, that is priced. That's the end game. That's what we're looking for. So there are different methods. There's the comparable uncontrolled price, resale price method, cost plus transactional net margin, transactional profit split. So there are like 5 acknowledged methodologies for determining what the arm's length transaction price should be. And what typical transfer price discipline will do is go through them and say whether that particular method is appropriate, and if it is not appropriate, say why. And then you end up using one, or maybe 2, but one method ideally that fits that specific transaction. So it creates a corporate governance as to how these related party transactions should be priced. And then you have documentation on a rolling basis, where every time that transaction is done, you justify that a certain process and procedure was observed to ensure that's a fair price. So transfer pricing is a huge deal, and tax authorities pay attention to it. In Singapore, the threshold for transfer pricing is relatively high. I think it's $1 million Sing. But in the US, there is no threshold. So once there is any sort of intercompany transactions with the US, then with involving a US company and another related one, you would want to have a conversation with your advisors to see whether transfer pricing is appropriate. And often it is. So hope that helps.
Please subscribe, like, share, and comment below. Our books and upcoming events are available at htj.tax. Email us at help@htj.tax to engage us, to advise on international tax or business matters.